Open. Anthropic is paying Zay, specifically, paying to rent space inside Zay's data center infrastructure, $1.25 billion a month. That number surfaced in SpaceX's IPO filing, which means it's in a disclosure document, not a press release. Annualized, that's $15 billion a year in rent from a single frontier AI tenant to a single landlord. Let that structure sink for a second, because the institutional red here has nothing to do with Elon Musk or Sam Altman or the AI arms race narrative. The read is this: when a tenant is willing to commit $15 billion per year in occupancy cost, before a single line of software revenue is recognized, lease economics for mission-critical compute infrastructure have permanently repriced, not cyclically, permanently. And the operators and sponsors I'm talking to who are building or acquiring data center assets right now are still modeling residual values and exit cap rates anchored to 2021 and 2022 transaction comps. That gap between where the market is trading and where the underwriting still lives, that's where I'm spending my time. The data layer. Let's put receipts on the table. According to CBRE's 2024 Global Data Center Trends Report, North American colocation absorption hit a record 2,600 megawatts in 2023. That's up roughly 70% year over year. JLL's data center outlook for the same period shows primary market vacancy: Northern Virginia, Phoenix, Chicago, Dallas, Silicon Valley, sitting below 3%. Below 3% vacancy in an asset class that was routinely running 8 to 10% as recently as 2020. Green Street's coverage of the publicly traded data center REITs, Equinix, Digital Realty, Iron Mountain, shows and lease rates for hyperscaler grade capacity in primary markets have moved from roughly $110 to $130 per kilowatt per month in 2021 to $175 to $220 per kilowatt per month in late 2023 and into 2024. That is a 40 to 70% rent increase in 36 months in an asset class that historically moved in low single digits annually. On the transaction side, Real Capital Analytics and industry data from Cushman and Wakefield both show cap rate compression that mirrors the rent movement. Stabilized hyperscaler tenanted data centers in Northern Virginia were trading at 5.5 to 6.5 cap in 2021. By mid-2023, comparable assets with long-term and leases to investment-grade tenants were clearing at 4.5 to 5.5. That's 100 basis points of cap rate compression in a rate environment where every other CRE asset class was moving the opposite direction. That divergence is not noise. That's a structural repricing driven by a tenant base that has an entirely different cost of capital calculus than a traditional commercial tenant. Now layer the Anthropic Zay number. On top of those comes $15 billion a year in rent from one tenant to one landlord. For context, Equinix, the largest publicly traded data center REIT in the world, generated approximately $8.2 billion in total revenue in fiscal 2023, per their 10-K. Anthropic's single lease commitment is nearly double Equinix's entire top line. That is not a data point about AI hype. That is a data point about what a frontier AI lab is willing to pay per unit of compute capacity, and it establishes a new ceiling, or arguably a new floor, for what mission-critical AI tenants will sign. The mechanism. Why did lease economics reprice this hard, this fast? There are three converging forces, and I want to be precise about which one is dominant. First, the power constraint. This is the dominant driver. Data centers are not a real estate story in the traditional sense. They are a power story with a building around it. The median hyperscaler GPU cluster, an H100 or H200 build at scale, requires 20 to 100 megawatts of critical IT load. Securing that power from a utility, in a jurisdiction with available grid capacity and transmission infrastructure, with a timeline under 36 months, is the actual scarce input. Dominion Energy in Northern Virginia, which serves the largest data center market in the world, has publicly disclosed interconnection queue backlogs running 3 to 5 years for large commercial loads. That is not a permitting delay. That is a structural supply cap. When power is the binding constraint and not land or construction cost, the operator who already holds permitted, energized, or nearly energized capacity has pricing power that doesn't exist in any other CRE product type. Second, the tenant duration shift. The hyperscalers, AWS, Azure, Google Cloud, have historically preferred shorter lease terms, 5 to 7 years, with renewal options, because their infrastructure roadmaps turn over faster than a typical commercial tenant's. What changed is the frontier AI layer. Anthropic, OpenAI via Microsoft, Zay, and a handful of others are now signing 10 to 15-year end structures because the infrastructure build-out required to support training runs at frontier scale is not portable. You don't move a 100-megawatt GPU cluster on a 3-year lease cycle. The capital commitment baked into those facilities locks the tenant in ways that older colocation agreements simply didn't. That duration shift is what makes the asset underwritable at tighter caps. You're not just buying a real estate cash flow, you're buying a utility-like cash flow from a tenant who has structurally high switching costs. Third, the supply lag. Data center construction timelines run 18 to 36 months from site control to energization for a purpose-built facility. The demand surge that started in late 2022 and accelerated through 2023 hit a supply pipeline that was sized for the pre-generative AI world. That gap closes slowly because power procurement is the bottleneck, not concrete or steel. CBRE's pipeline data shows roughly 4,200 megawatts of capacity under construction in North America as of early 2024, but only a fraction of that will be delivered to hyperscaler grade spec by year-end. The vacancy number stays tight for a longer runway than most people are modeling. Where mid-market capital fits. Here is where the institutional framing matters most, because when most people hear data centers, they think Equinix, they think Digital Realty, they think $500 million campuses in Ashburn. That is not where I'm looking. The specific subsegment that is mispriced for a principal moving $10 to $75 million is the powered shell and the secondary market colocation play. Powered shell is exactly what it sounds like, a purpose-built or adaptively repurposed industrial shell with committed power, fiber, and cooling infrastructure, delivered to a tenant who installs their own IT equipment. The landlord never touches the compute. The basis on a powered shell deal is substantially lower than a fully fitted colocation facility. The construction timeline is shorter, and the tenant, often a regional cloud provider, a managed service provider, or increasingly a mid-tier AI inference company, is signing end leases because the power commitment creates the same switching cost dynamic I described earlier. Deals I'm seeing in secondary markets, think Columbus, Reno, Kansas City, San Antonio, are clearing at 7.5 to 9 cap on a stabilized basis with 10-year end leases to tenants with solid credit. That spread against primary market caps of 4.5 to 5.5 is not justified by the underlying risk differential in a power-constrained environment. The power is the asset. If you have the power, the market finds you. The other entry point is acquiring existing colocation assets at a basis that still reflects pre-2023 lease comps. There are owner-operators, regional colos, small carrier-neutral facilities, whose in-place leases were signed in 2019 or 2020 at rates that are now 40 to 60% below market. If you can acquire at a basis that prices the in-place NOI at a reasonable cap without giving full credit to the mark-to-market upside, and you have the operational capability to release at current rates as those contracts roll, the IR profile is asymmetric. The challenge is operational. This is not passive real estate. You need either an operating partner with carrier relationships and technical staff, or you're underwriting a turn you can't execute. Counter positions and risks. The bears have real arguments. I want to name 3 specifically. 1. Tenant concentration. The Anthropic Z structure I opened with illustrates both the upside and the fragility. A single tenant committing $15 billion a year to a single landlord creates a lease comp. It also creates existential counterparty risk. If Anthropic's capital position deteriorates, if a model architecture shift reduces compute demand, or if the regulatory environment around frontier AI changes materially, that tenant's ability to sustain that rent commitment is not guaranteed. In the mid-market context, an inference stage AI startup signing a 10-year and on a powered shell is not Anthropic. Underwrite the tenant as carefully as the asset. 2. Power cost inflation. The same power scarcity that creates landlord pricing power also creates input cost risk. Utility rates in constrained markets are moving up. PJM capacity auction prices for 2025 and 2026 delivery cleared at levels that surprised even operators with long utility relationships. If your power procurement is on a variable or short-term contract and your lease is long-term and with fixed rent bumps, the spread compresses in ways your acquisition underwriting didn't model. 3. Technology obsolescence risk at the asset level. Cooling infrastructure, power density per rack, fiber diversity requirements, these are not static. A facility built to 10 to 15 kilowatts per rack in 2018 requires meaningful capex to support the 30 to 50 kilowatt densities that current GPU workloads demand. If you're acquiring an older colo at what looks like an attractive basis, You may be buying a capex project, not a cash flow asset. Get an independent technical assessment of the mechanical and electrical infrastructure before you close. The position I'm taking. Right now I'm actively looking at two structures. First, powered shell development in secondary markets where a site control and power procurement package can be assembled at a basis that supports a 7.5 to 8.5 cap on a 10-year and lease to a creditworthy tenant. My focus is on markets where utility relationships are already in place and the interconnection queue is in 48 months. Specifically Texas ERCOT adjacent markets and certain Midwest utility territories where load growth hasn't yet overwhelmed grid capacity. I'm not building the compute, I'm building the building and the power delivery. Tenant installs their stack. Second, I'm evaluating a specific co-investment opportunity in an existing regional colocation facility in the Southeast with in-place leases that are 35 to 40% below current market rates. The leases roll over a 24 to 36-month window. The acquisition basis prices the in-place NOI at a 7.8 cap, with no credit given to the mark-to-market. If we had current market rents on renewal, the going-in basis implies a stabilized cap north of 11. The operational dependency is the variable. We're in diligence on the operating partner structure now. For principals who want visibility into either of those deal paths, whether as co-investors on the equity, as lenders against the asset, or as brokers with pre-vetted opportunities in powered industrial or colocation, the right move is to come to me directly. Close. The Anthropic Lease disclosure isn't an AI story, it's a repricing event for an entire asset class, and the comes are in the public record. When vacancy is sub 3% in primary markets, when and lease rates have moved 40 to 70% in 36 months, and when frontier AI tenants are structurally locked into their infrastructure in ways that create utility-like cash flows, the underwriting framework for data center real estate is not 2022 anymore. The mid-market opportunity is real. It's in secondary markets, powered shell structures, and basis arbitrage colo acquisitions, but it is operationally complex. Power procurement, tenant credit, mechanical obsolescence, and lease mark-to-market timing are the variables that determine whether you're buying a compounding asset or a problem. That's where I'm spending my diligence hours. If you're a principal, sponsor, or deal broker with relevant flow in this space, DM me at @DeBrody Official. I route every inquiry personally.